Zuma signed two pieces of legislation into law. These are the 2015 Tax Laws Amendment Act and the Tax Administration Laws Amendment Act, both coming into effect as of the 1st of March 2016. These laws will consequently impact members' retirement and provident funds. And talking to us about this is Piet Nel. He is the head of the School of Applied Taxation at the Institute, or the SA Institute of Tax Professionals. Good to have you in studio. Welcome to Morning Live.
Yeah, thank you. Nice to be here.
All right. What should people expect as of the 1st of March? What do we need to know?
Well, I think the first thing that one must remember is it only affects members of provident funds.
Okay.
We've referred there to the pension and the retirement annuity funds.
Yeah. They
are not really affected apart from their deduction. So
okay.
In a sense, it's persons that belong to provident funds that are the most adversely affected by
this. So pension funds, retirement funds are exempt from this? This is provident funds?
Well, let's just say the regime regarding the pension provident funds, pension and retirement annuity funds stay the same apart
okay.
from certain small changes. So the first one is where your employer contributes on your behalf to the fund, that becomes a fringe benefit. It will be subject to tax, but your deduction increases. So effectively, most of those persons would be not affected. The tax
okay.
position would stay the same.
Right.
That's the provident fund members that are affected.
How is it going to be affected? What should we know?
A provident fund, maybe I'm going to start by explaining the difference between the two. So a pension and retirement annuity fund, same rules. Provident fund have different rules. And essentially, so over your life you contribute. You start your work and you contribute ideally so that when you retire you've got money to live on because you're no longer getting a salary. The provident fund allowed you to cash out on retirement the full amount, whereas the retirement annuity and pension fund rules require that you take 1/3 in cash only on retirement date, and the rest must buy your pension for the remainder of your life. So 2/3 of your retirement interest at retirement date must be used to buy a retirement annuity. So this is a big difference, and this is why a lot of people are being affected, because the law applies to all people that are under the age of 55 at the moment, at the 1st of March 2015.
Okay.
So going forward, they will be affected by this.
Yeah. So anybody over the age of 55 are entitled to take the entire lump sum?
They still have the old regime. Their rights are entrenched, John.
Okay.
Yeah.
You know, a lot of people are not happy with this at all because they may have already made plans with that money and said, well, okay, as soon as I'm finished, I'm going to go and I'm going to start up my own business, or I've got something that I want to buy, or they've got plans. But these plans have now been, I suppose, hampered by this.
Yeah, maybe one must, I hear that, and I think this you're right, people have this expectation. Now, I have a view that if you're not financially astute and you retire, it's more likely that you will use your lump sum. If you suddenly have a lot of money, and in some instances not that much. If you look at most of the employees that are affected by this, are more the bottom earners. Then you are more likely to lose that money and not have any money, and then become a burden to the state.
Yeah.
So in a sense, one must be very careful to say that, yeah, I have planned and I know that I will be getting the money, but as we say, it's the people below 55 that are being affected by that. So you certainly have enough time to change your plans. If you left the firm before retirement age, the law doesn't change and you can still access your full money there.
Yeah. A lot of people again saying that they feel that government are almost telling them what to do with their money and how they can use their money. Is this common practice in a lot of other countries, the way things are changing? It
is common practice. I think government is what government policy is, and I agree with this policy. They say if we give you a tax benefit for your contributions, then we want to prescribe how you have that. There's a really bad culture in South Africa of investment. We don't invest. So most of our elderly people are reliant on other people. So what the government policy now is we'll give you a tax benefit. We won't tax. We'll give you the ability to reduce your taxable income with your contributions to the Provident Fund, as we've done with the retirement funds in the past. And the quid pro quo is that we require you to take 1/3 in cash only and 2/3 must buy the annuity.
Yeah. So as a tax specialist personally, do you agree with this?
I agree with this law, yeah. For two reasons. The first one is that we now have same treatment. So up till the end of February this year, a retirement annuity fund and a pension fund person was treated differently to a provident fund. So there was this difference, and of course, and it's also a very complex law. So people were making this thing. And the other thing is, I say that I believe that not all are, without saying that we all know the things, I believe that most people are not financially astute in this economic climate to take the lump sum that they have and to provide for their old age. There's a risk that they lose that money.
Yeah. Again, to viewers out there, if you'd like to ask any questions too, Piet, right now we've got him in studio, so you're more than welcome to tweet us at Morning Live SABC. We'll take those questions and ask them to him right now. Government issued a statement yesterday saying that the President didn't take this decision unilaterally. As a tax specialist in this country, were there enough consultations?
I believe there was. The law was actually as relatively little change. I can maybe explain what changed. So this was also already introduced into the Act in 2013. And then last year in the budget speech, the Minister postponed it with 1 year to say that NETLAC and COSATU and the trade unions were concerned about this and wanted to negotiate, and I wanted to speak about that. So for one full year, there were consultations. I was certainly involved in October this year. We were at National Treasury and SARS. We were meeting with us, and we were all giving our views on whether this was a good thing or not. There were 3 options on the table at the time. And again, then we went to the Standing Committee on Finance at Parliament and spoke about that. And the consensus from most parties involved was that they agree with SARS, and I talk about tax professionals, I talk about your retirement fund industry as well, and most people feel that. So there were really some COSATU, of course, being a big representative in that disagreed with that and didn't want that.
Yeah, I mean, one of the clips that we've got in the news from one of the unions saying that this is a very colonial way of thinking, and that this is not the way that we should be implementing our tax laws and regimes. Again, I ask you, is this a very colonial way of thinking? I
don't understand why they say that. If you still have an option. So most employees are forced, when they work for their employers would have a fund, and you have the rule. So when you join the SABC as an employee, they say this is the rule. You belong to the fund, and we contribute on your behalf. As an employee, if your employer doesn't have, they can elect out of that. You can take a certain amount of your money, invest it in your own fund, and look after your own retirement fund until the date of death. So I don't think that this is really forcing it. It's saying that from a tax point of view, we are saying that if you want to take a tax deduction, we want certain things attached. So you get the benefit of not being taxed on that income now, and for your working career, which may be 40 years, you can tax efficiently put money into a retirement fund and then retire at the end of the period and then have some tax consequences. You're deferring the tax on that.
Yeah.
So I don't believe that it really is, and it is quite common in the world.
Yeah. Just on a final closing note, because we have seen a lot of anger from people out there at this announcement, and I mean it's coming in a month's time.
In a month's
basically.
time, yeah.
What advice do you give them at this time?
Yeah, I think people mustn't make hasty decisions. So mustn't say now that it's changing, I must move out of my fund, because that would be bad advice. If you want to, and employers alike, if they're concerned that this is negatively affecting them, and I don't think it really does, it affects people that contributes more than 350,000 per year. So this is the high earners, and they probably have access to that. So I would advise people to consult, not make hasty decisions, and understand that this only affects them when they retire. It doesn't change anything now in their working career until retirement age. So employers maybe should assist employees to understand and also explain to them what the risk is of taking the money in full on your retirement date, as I say, because the risk is that you may not have enough then to live until you die.
Just forgive me, my director. I've got 1 or 2 questions coming through. If we can do this quite quickly, and I think we've answered most of them. What are the objectives of the tax and retirement reforms?
The objective is to streamline, to make sure that the funds are treated equally, so that there are no differences between that, and to sort of force people to, the investment benefit of that, so that if you're not entitled to take the full amount out, you will keep money saved in that. So it's to enhance the savings at retirement, and to, as I say, to make sure that the funds are treated equally.
Okay, that question, my fellow, thank you for writing into us. Gabriel writing in saying, so now with this new law, between now and the 1st of March, are you going to see a lot of withdrawals from the Provident funds? And that's the advice you said. Don't do it. Yeah, you can, as a member of the fund, you can only withdraw if you actually, so I wouldn't advise people to do that.
the tax on a withdrawal is a bit more harsh than on a retirement. So on retirement, you can take R500,000 out and not pay any tax on the lump sum.
Yeah.
If you withdraw, the first 25,000 is tax free, and the next balance gets taxed at 18%. So that's quite a huge knock to try and make up 18% in the current investment climate. So I definitely would advise people not to take out the funds now.
Finally, last question. Bule is saying, does this apply? Sorry, guys, this is people's livelihood. They want me to ask these questions. Does this apply to members who resign as well?
It doesn't. The regime, as I say to people that resign, hasn't changed. So you, at resignation, you can take, and that is very important. So it's a good question, a very important point. If you resign, you can still take your full lump sum amount out. That would be taxed, but it would be tax beneficial to transfer it into another retirement fund.
Yes.
That is no tax consequences. It only applies to people that actually retire.
There's so many more questions, but I've got to let you go.
I imagine so.
Thank you, Piet. Thank you very much for coming. I think you've really given us a lot of understanding as to how this works. Piet Nel is the head of the School of Applied Taxation at the SA Institute of Tax Professionals. Thank you.
My pleasure.
Let's take a break. After this,